Hey everyone, welcome back to the channel. Today we're going to take another look at Palantir. In my last video from about a year ago, I had a relatively conservative initial valuation and wasn't fully convinced on their ability to grow into their $43 billion valuation. In my view, their customer base wasn't large enough to actually achieve the revenue necessary, or if they acquired vastly more customers, the average revenue would need to decline significantly, as they were sitting around $7.9 million of revenue per customer. I've worked at a few different Fortune 500 companies over the years, and in my experience, any contract over $1 million requires significant approvals and wasn't entered without sufficient due diligence. This led me to believe Palantir's customer base at those levels of revenue would only be Fortune 500 companies, and a subset of those companies even at that. In the last year, Palantir did prove me wrong, with an impressive 41% revenue growth and increasing their customer base from 139 customers to 237, which is an impressive 70% growth. Now, I do feel slightly vindicated as their average revenue per customer dropped from 7.9 million down to 6.5 million. But this still left me with questions of what companies were spending almost $6.5 million annually with Palantir. This led me to do a little bit more analysis on the customer data that they provide, and after a bit of normalizing, we can separate out the average revenue for the top 20 clients and all the rest. When we actually disaggregate the revenue from these largest 20 customers, and we see how much of their revenue is skewing the average revenue per customer. So in order to do this, I took the numbers provided by Palantir, showing the average revenue for the top 20 customers. This has grown from 21.7 million to 43.6 million from 2018 to 2021. We can take this average per customer, multiply it by the subset of 20 customers, and get the total revenue for those customers. The top 20 customers have made up 73%, 67%, 61%, and 57% of total revenue going from 2018 to 2021. This then allowed me to take the remainder of Palantir revenue and divide it by the total number of customers that are left over. And this would get us the average revenue per customer excluding the top 20. This gives us an average revenue per top 20 customer of 1.7 million, 2.2 million, 3.6 million, and 3.1 million from 2018 to 2021. These averages are almost half of what Palantir reports as their average revenue per customer, which makes a little bit more sense to me. I'd imagine if you took the top 20 and expanded it to the top 30, the average for the rest would drop off significantly more as well. I think this is a very skewed distribution of revenue. This analysis really put into perspective for me the first big risk I see with Palantir: customer concentration. Palantir has done a good job diversifying their customer base, but the top 20 customers still make up almost 60% of total revenue in 2021. If they lose any of these customers, it poses a significant impact to total top line revenue. I will say I'm happy with the trends we have seen, with the top 20 going from 73% down to 57% over the last 4 years, but I would love to see the numbers drop below 50% by the end of 2022. I think this is a top priority as well for management. They've released figures around their commercial sales team, and in 2021, they grew in the US from 12 to 80 individuals, which led to a double of their US commercial revenue as well, from 100 to 200 million. And they've announced they're continuing to invest significantly in hiring for these sales roles. The other announcement they've made is they are taking the same sales strategy that they deployed in the US and applying it to their non-US commercial business as well, to expand across Europe and Korea. These investments will come with costs without a doubt, so I don't expect margins to improve significantly anytime soon, but that shouldn't be an issue as long as we see the top line revenue growth and the diversification of customer base. Now, the next thing I want to quickly hit on before we jump into the DCF is stock-based compensation. I've pulled together two different DCFs, one excluding stock-based compensation and one treating stock-based compensation as an actual cash expense. Now, normally when stock-based comp is immaterial, think 2 to 3% of total revenue, you back it out and you never think about it again, as the impact of dilution is pretty small. But with Palantir, we've seen them issue 116% of revenue in stock-based compensation in 2020, 50% of revenue in 2021, and in the last 4 years, they've issued $2.5 billion of stock-based compensation to employees. At the current market cap, that's roughly 10% of the market cap issued in stock-based compensation in just 4 years. This is a significant amount of stock-based comp. I understand when they direct listed, they rewarded employees, made a lot of people rich, but they did this at the expense of shareholders. If you want to do some reading, I've linked below a great blog post by everyone's favorite finance professor, Aswath Damodaran. Definitely give it a read to understand why we might actually want to include stock-based compensation in our DCF if it's a significant amount. Now that we've covered those two topics, the last thing to do is jump into the DCFs and take a look at how Palantir actually looks on paper. I've linked the DCF below. Please download and check out the formulas to see how I calculate everything and make any adjustments you don't agree with. We'll start with my DCF where I remove stock-based compensation. The first thing I want to discuss is my revenue estimates. You can see these are much more aggressive than what I had about a year ago. This time I've decided to trust management and use the estimates they have provided. They stated in the accompanying remarks to their 2021 financials that they expect 30% revenue growth for the next 3 years to come. I've layered this in and then had the revenue slowly taper off until it stays steady at about 11%. This takes revenue from $1.5 billion in 2021 to $8.5 billion in 2031. This feels aggressive to me, but Palantir has shown that their large customers like their services and continue to spend more with them every year. And with the aggressive investments in their sales force, I believe this might actually just be doable. The next thing to talk about is COGS. I've layered in slight improvement as revenue grows. This is based on the fact that they're offering a software as a service. It should benefit from scale as the primary cost was the development, and that's already done. And there isn't really true incremental unit cost. Next is SG&A. I've held this level of investment flat to 2021 for the next 3 years and then had it slowly drop off. This is due to the aggressive revenue targets in the next 3 years, leading me to believe they will need to continue investing in a sales force and marketing. Lastly is R&D. I've held this flat for the next decade. If they want to keep customers and continue to grow and gain new ones, they're going to need to continue to invest in their product. This is really CapEx for them. You usually can't amortize software development costs, so you tend to see higher R&D costs in these SaaS companies than you would in a traditional company, but you don't see the company capital expenditures either. So based on these assumptions, we get a valuation between 23 to 28 billion using a 10% discount rate. I think 10% might be a bit low, but we'll give them the benefit of the doubt and say the large government contracts are safe and not risky and they will renew. If we compare this to the current valuation of Palantir, it's not too far off. Palantir currently trades around $13 a share, which equates to a $27 billion valuation. So we're pretty spot on. And if you believe margins can improve a bit faster, you can get that they're actually undervalued pretty easily. This would lead me to believe Palantir is a hold currently, maybe a buy longer term if revenue actually grows a little bit quicker than management's projections. However, I'd be remiss if I stopped here and ignored stock-based compensation. Let's hop over to the second DCF I pulled together where I've layered the stock-based compensation back in. I've held all assumptions the same, except I've layered in the 2021 level of stock-based compensation of roughly $800 million annually. This takes stock-based compensation from being 50% of revenue in 2021 all the way down to 9% of revenue in 2031, but still being an $800 million annual expense. With stock-based compensation included, we get a valuation between $16 to $20 billion. This represents a 26 to 40% overvaluation at current levels, even if Palantir can hit management projections and 7x their revenue in the next decade. I truly believe the valuation, including stock-based compensation, is the better analysis to use. Tech company stock-based comp isn't something you can just shut off. I think Palantir is in this tough position due to being public with lower levels of revenue. If we look at Google, they give almost $100,000 in equity annually to each employee. I've calculated this based off some rough math, 125,000 employees paying out $11 billion in stock-based comp annually. With Palantir expanding aggressively, their workforce will probably triple in the next few years. A quick search says they currently have around 3,000 employees. An educated guess would tell me they are probably mostly software engineers, so we'll say 2/3. And the average stock comp for a software engineer is actually much higher than the average of a back office worker. Google benefits from having a lot of back office workers, bringing their average down. Now, if we say 2,000 of these 3,000 employees at Palantir are software engineers, and they actually need an average of $200,000 of stock-based compensation, that alone is $400 million annually. And then the other 1,000 employees, we'll call them back office employees, they get $100,000 annually. That's another $100 million. They probably have around $500 million of stock-based compensation that they're obligated to pay before they expand their workforce as revenue grows. I think this cost will actually be very difficult for Palantir to control. If you cut stock compensation, employees will jump ship. Based on my belief that they'll have a very difficult time controlling stock-based compensation, I'd give Palantir a rating of sell for now. They need to show either a significant beat on revenue, improvement to margins, or a significant drop-off in stock-based compensation without an impact to employee retention for me to want to look further into an investment and see if it's warranted. If you think the stock-based compensation won't sustain these levels, you could make an argument that Palantir is a hold, but I still find it hard to give it a buy at its current valuation and its significant customer concentration in the top 20. As always, thanks for watching. Let me know if you have any questions or comments below. And if you haven't already, please like and subscribe.